Today I'm very happy to have with us Janet Yellen. Janet has served as a member of the board of the Federal Reserve Board, where she's helped set monetary policy for the country. She's also served as one of the economic advisors to the President, as chair of the President's Council of Economic Advisors. And let's actually start with that. As I recall, one of your main responsibilities as an advisor to the President was over the Kyoto Protocols. What are these Kyoto Protocols?
Well, the Kyoto Protocol was an agreement that was negotiated internationally in December of 1997, and it was designed to set binding limits on greenhouse gas emissions mainly by industrial countries. The problem relates to global warming. The scientific evidence has become increasingly clear and highly convincing, at least to my mind, that emissions of greenhouse gases are leading to an increase in average temperature levels in the globe, and that unless there are substantial cuts in greenhouse gas emissions, and the most important one for us is carbon dioxide that comes from fossil fuels, that there will be a whole range of adverse consequences that include an increase in sea levels that will be threatening to low-lying areas, possibly adverse consequences on agriculture, increased disease and a variety, increased storms and extreme weather events. So the object of Kyoto was to try to set binding limits by countries on their greenhouse gas emissions to begin to get this problem under control.
And so what did you do on this? I know you testified before Congress, but what was your responsibility on this protocol?
Well, it had been agreed that in Kyoto in 1997, at the end of 1997, that the parties, which are most countries in the world, would meet and try to negotiate an agreement. And every country had to go off to Kyoto with a set of policies to take part in this negotiation. And the United States is the largest emitter of greenhouse gases, so of course the United States would play a major role, and our participation was crucial. And first and foremost, President Clinton had to set off for Kyoto, had to put together a team and go off to Kyoto with a set of policies that he would take into negotiating with other countries over what the limits would be.
And did you have to negotiate these with members of Congress? Did Congress need to agree to these, or how did that work?
Well, international treaties must ultimately be approved by the Senate in order to take force. So the President can negotiate an international treaty and sign on to it, but for it to be binding on the United States, it has to be ratified by the Senate. And I and other people had testified on the possible economic consequences of the commitments that we made or discussed with Congress in testimony even before we went and negotiated the agreement, what we were thinking about, what the range of possibilities would be, what the possible economic consequences would be for the United States. But ultimately, later on, we knew that there would be a treaty that would have to be approved by the Senate.
Okay.
And the Senate had spoken actually rather loudly about their preferences about this. They were very concerned with the potential cost, and rightly so, because one of the things economists do is worry about costs and benefits, and trying to design environmental regulations or regulations in general so that they have a good cost-benefit ratio or the benefits exceed the costs.
Right.
And in this case, there was great concern that the costs of limiting greenhouse gases for the United States could be very large.
Now, let me interrupt. The policies that you recommended eventually were mainly incentives for various types of energy efficiency, such as tax credits for purchase of energy-efficient cars. Was this negotiated through the Senate, or why was the emphasis placed on the incentives?
Well, let me just first be clear that what happened in Kyoto was simply agreements on an international scale about what targets would be adopted for greenhouse gas emissions. It was left up to every single country to decide how they would go about meeting those limits.
Okay.
And what President Clinton decided was, at least initially, what he wanted to do was to get a start on improving energy efficiency through a carrot approach rather than a stick approach, to use markets wherever possible rather than simply command and control kinds of regulations, because here the issue of cost is very important. And typically, I think economists have found that working with markets and using incentives tends to realize goals in a less costly manner than simply giving detailed directives to firms as to what kinds of technologies they should use or what individual limits should be. Mm-hmm. The Clinton administration early on proposed some tax credits to foster, facilitate, motivate some investments in things like very fuel-efficient cars or fuel-efficient energy systems for homes. Those, Congress would have to pass those, and legislation was submitted, but Congress never did pass those incentives. Ultimately, to meet the agreements that were set in Kyoto, which were for very substantial reductions in greenhouse gases, we agreed to cut to roughly 7% below 1990 levels, which really is so this took place in 1997, and to put that in perspective, we agreed to do this by 2010. And since we're a growing economy and tend to use more fossil fuels as we grow, there's some energy improvements, but still, as GDP grows, we tend to use more energy and emit more greenhouse gases. We would be on a path where there would be growing emissions, and over the space of essentially a decade, we were agreeing to essentially major cuts from that baseline.
Now, when you say that the administration makes recommendations for the tax credits, what was your role in that? Do you make recommendations to the administration on what policies should be pursued, and then they adopt, or the president adopts or doesn't adopt them? What was your role?
Well, the president every year presents a budget, and a budget is a time when it's natural to put forth programs and policies supported by allocations of either direct appropriations in the federal budget or tax schemes like the tax credits President Clinton proposed. That's a natural time for a president to explain to Congress and the State of the Union, to the American people, what his priorities are. And an economic team within the administration, it consists of people from any number of concerned agencies, plus people in the White House, economists, but not just economists. In this case, there were environmental folks and lawyers who were involved in this. There are working groups in the White House that manage an interagency process that in this case led to the proposal for these tax credits. That was presented as part of a budget that had many other elements connected with it as well, of course, proposals for education and Social Security and other things. But so there's an interagency group, and I met on many occasions with people from Treasury, people from the Office of Management and Budget, and the Environmental Protection Agency, and the Energy Department. All of those were players, and we tried to hammer out what would be good proposals and to put forward a package. Ultimately came out in the president's budget.
Great. Now let's go back in time a little bit. You were on the Federal Reserve Board.
Yes.
Now I've always wondered, the Federal Reserve Board sets monetary policy, raises and lowers interest rates. You have a meeting periodically and make decisions. How do you come to a decision? Do you talk among yourselves and then vote and the majority rules, or is there consensus, or how does this happen?
Well, there is ultimately a vote. There is a committee, what's called the Federal Open Market Committee, and the Board of Governors consists of 7 governors, of whom the chairman is the person best known to the outside world at the moment, Alan Greenspan, and he is the first among equals. Everyone has one vote, but he is the leader of this committee, and of course he commands enormous respect in the United States and around the world. And he does exercise leadership in suggesting to the committee what he thinks would be a good proposal as to what we should do. Of course, his views have to be ratified by a vote. The 7 governors, and then in addition to this board in Washington with its 7 governors, there are 12 regional banks around the country. We have one here in San Francisco. And the presidents of each of these regional Federal Reserves also participate in this committee. At any given time, Congress set this system up so that only 5 of them vote. Always the president of the New York Federal Reserve. He's always a voter. The New York Fed actually conducts monetary policy operations. They're charged with doing that. And then 4 others on a rotating basis. So there are 19 members of the committee, the 12 presidents, 7 governors. They all participate all the time. It's full equals until the vote comes. And in that case, 5 presidents vote and 7 get to participate but don't vote. And usually the way it's worked, it's been different under different chairmen. But under the Greenspan regime, we have discussions first in which everyone participates of the economy and what the trends are in the economy. And then we start a second round of discussion. Usually the chairman goes first, and he makes a proposal and presents his ideas as to what a good policy would be for policy decision for that day. So there are about 8 or 9 meetings a year. Every 6 weeks or so the committee meets, and he makes a proposal, and then people react to it. And usually he's good at knowing what people are thinking, and he hears one time what people are thinking, and then that helps him understand what the views are in the committee for the next time. Right. He puts forward a proposal that people can accept. So unlike the Supreme Court, where you also often have close votes, 5-4 votes, and a lot of acrimony, it's pretty rare to get dissents. There'll be an occasional dissent, but if there are more than 2, it's really, the newspapers will note it, and it's it's unusual. So yes. People respect his opinions, but their opinions also count.
Now, these decisions affect billions of dollars of investment in people's incomes, millions of jobs.
They do.
Do you find it at all nerve-wracking making these decisions? I mean, how do you sleep at night worrying about it?
Well, it is nerve-wracking. I remember when I was sworn in as a Federal Reserve governor, it was August of 1994, and interest rates had been very low for a long time. They had been at the key rate that the Fed sets had been at 3%, been quite low. And unemployment was still really pretty high. I mean, it was close to 7%, 6.5% or so. The economy was beginning to recover, but there had been a long recession in the 90s and a recovery, but it was called a jobless recovery. Unemployment stayed high. And suddenly the Fed had decided before I got there the previous February to start raising interest rates. And I think they felt there are long lags in the operation of monetary policy. When the Fed raises rates, it can take anywhere from 6 months to 18 months for the impact to be felt on the economy. So, while the economy certainly wasn't overheated when I got there, let alone the previous February, the fear was that the economy was now growing so rapidly that it would become overheated, hence the need to raise rates. Well, I confess I wasn't so sure when I got there in August of 1994 that that was really the right thing to do. And this involves making a forecast of where is the economy going. Right. And it's, macroeconomics, I think it's a very useful set of tools for thinking about the economy. But in terms of our ability to know the future and to forecast where things are going, that's a very difficult thing to do. There are a lot of imponderables. So it requires some confidence to know that you should be increasing interest rates. And higher interest rates are something people really don't like. I would go to parties and, meet people, and for the first time people would say, I'm losing money because you're raising interest rates and what you're doing is harming me.
They would blame it on you.
I never had that experience before, but of course, as you say, it really does affect interest rates, and people worry about their jobs. And Suddenly the job market is finally beginning to improve, and why is the Fed raising interest rates here? Well, so at the personal level, when people say that to you, when you're at a party at a friend's house and people say, so you voted to raise interest rates, it drives home to you the important responsibility that you bear personally for making decisions that are in the best interest of the economy. Now, so why would the Fed do that? They really felt quite sure that the economy would overheat if they left interest rates that low. Ultimately, inflation would rise. And what economists have found, and this is particularly the research of our colleagues David and Christy Romer, have shown that most post-war booms or expansions have come to an end because the Fed allowed the economy to overheat, then had to clamp down, tighten monetary policy to get inflation down, and that caused a recession.
Well, now this leads into one thing I wanted to talk to you about. Also, you've just come out with a new book called The Fabulous 90s. I love that term. What was so fabulous about the 90s? What's the reason for the title?
Well, I think if you look at some of the key indicators of macroeconomic performance, the unemployment rate, inflation rate, the growth rate of the economy, GDP growth, and productivity growth, on all of those metrics, this has been the longest expansion we've had in all of recorded U.S. history since the 1860s, when they started maintaining records. It's the single longest expansion, and unemployment has fell during this expansion. It got as low as 3.9%. And we haven't seen unemployment rates like that since the early 60s. And most economists, when I went to Washington in 1994, most economists actually thought that inflation would begin to increase if unemployment fell below 6%. And here unemployment fell all the way to 3.9%. And while the economists at the Fed and elsewhere feared that inflation was going to rise, in fact, what happened is that inflation continued to come down.
Yes, it was remarkable.
So it was, economists sometimes look at something called a misery index. So the sum of two bad things, unemployment and inflation, and you add them together, and that's the misery index. And the misery index hit its lowest point in the post-war period during the fabulous decade. So we had low unemployment, low on inflation, and the miraculous thing is that productivity growth, which is ultimately what determines the pace at which living standards improve, that improved too.
Now, has the collapse of the dot-com industry changed your view of how fabulous the 90s were, or does this reinforce it, or how does that play in?
That's really an important question, and it's one of the open issues for the future. One of the great things about the fabulous decade is after 1995, suddenly the pace of productivity growth, output per worker, output per man hour, which had been really depressed ever since the first oil shock in 1973, it suddenly picked up. And optimism, it seemed as though new economy technologies, computers, software, communications technologies were all coming together to make firms find ways to improve their efficiency. And we saw a decided and large pickup in productivity growth. And that continued into 2001 before the economy started to weaken. But along with that, we had, as you know, this huge increase in stock prices, great optimism about earnings, and we now know that, and it was suspected at the time that maybe this was a bubble in the stock market, maybe there was hype behind the new economy, it wasn't all real, and certainly in some things, fiber optic cable, the dot-coms, we had overinvestment and financing of ventures that really didn't have a realistic chance. Well, now what does the future hold in store? Are we going to have continued more rapid productivity growth? Is that going to continue? I'm actually pretty optimistic. I always thought that we had a bubble in the stock market.
Yeah.
Often when you have faster pace of advance in technology, people think they'll get rich off it, managers or firms. But in a world where there's competition, sometimes you have an idea, you set up a firm and you think you're going to get rich from it, but someone else copies your idea, and the fruits of this innovation end up being passed along to consumers and don't lead to such huge profits. Yes. I think this occurred in electricity when it was invented. People didn't get rich off investing in the companies that made electricity, but it was a wonderful innovation. I'm hopeful that there are real innovations and that the pace of innovation will continue, even though the stock market was clearly inflated and
yes.
is adjusted, but nobody knows, and it's something we're going to have to wait and keep our fingers crossed and study.
It's very optimistic. I'd like to ask you a personal question, too.
Okay.
You can teach any place in the world. Why did you choose Berkeley?
Well, I think Berkeley is a wonderful place to be. It's a terrifically lively, active community in every field, but particularly in economics. We have many groups of economists on campus in the economics department, in the business school, in natural resources, and around the campus. And we have a very nice, very supportive community of people who interact yes. and help one another in their research. And we have a wonderful group of students, both undergraduates and graduates, that are a pleasure to teach at every level. And it's an intellectually stimulating place. It's good to teach and good to do research yes. here. So I've liked it very much.
I love being here. I've enjoyed this interview with you. I really appreciate your coming today.